So this webinar series is designed solely to discuss the basics of trading. For some of you, this will be just what's needed for you to define a concept or some terminology. For some of you, this will simply be a review of concepts that you already know and understand. If you have any questions, feel free to type them in, and I will do my best to get them answered as we go along. Before we get started, I thought it would be nice if you could put a face to my voice. And so I had Ross, our most excellent admin assistant and super duper IT guy, put up a picture. However, he snuck one by me, and that's not even me. It's Bruce, that's true, but that guy can sing way better than I can. So I got to tell you, Ross is in big, big trouble. So the subject for tonight is, what is a stock? And a stock is simply the shares of a particular company. All stocks have ticker symbols, and the ticker symbols identify in shorthand the name of the company. And you can look these up. One of the places you can look them up is on Yahoo Finance. So if we were to look at this list, the first one is MSFT, that stands for Microsoft. The second one is ORCL, that stands for Oracle. The third one is AMZN, that stands for Amazon. And the third one is ERTS. That's an unfamiliar one to me, so I just went to Yahoo Finance. The stock was named for the company Electronic Arts Inc. And when I typed that symbol in on the home page of Yahoo Finance, and I also found out that the symbol has been changed to EA. So you can get all kinds of interesting information that we'll use for trading, and one of the places that we look at is Yahoo Finance. So all businesses, whether they're small or whether they're big, if they have shares, they all have these ticker symbols. And we use the same techniques and methodology for trading them, large or small. So why does a company even have shares in the first place? Well, let's try to illustrate this idea. And let's say you have a company. And in your company, you need to raise money for R&R. That means research and development, not rest and relaxation. So you need some money for R&R. So there's basically two ways that you could raise money. The first way would be to borrow money, but then you'd be taking on debt. The other way is to sell shares. This way you can raise money and not take on debt. I don't know about you guys, but I kind of like way number two, and so do a lot of other companies, because a lot of companies have shares that are traded on various exchanges. So in your company, you could divide the company into 1,000 pieces or shares, and you could price each share at $1. So you sell all the shares. So 100,000 shares that you sell times $1 for each share, and there's your $100,000 for research and development. But I want to introduce a bit of terminology here, and it's EPS, something that we use in our fundamental analysis, stands for earnings per share. So after you sold those shares and you were going about your company business, let's suppose your company made a yearly profit of $50,000. Now each share that was sold is entitled to a share of the profits. In fact, that's how they originally got their name, because each one is entitled to a share of the profits. So if you had $50,000 earnings divided by 100,000 shares, that would give you 50 cents EPS, or earnings per share. Does it make sense? So at some time or another, a company may decide to go public. And usually it's a size related thing. And going public is also known as floating the company for our English friends. I don't know if Jonathan from England is listening, but if he is, howdy, mate. Or over here we say taking it public. So the company gets with an investment banker like Merrill Lynch, Goldman Sachs, or Morgan Stanley, and they go to an exchange like the New York Stock Exchange. When they start selling shares to the public, it's called an IPO, or initial public offering. A famous recent IPO was Facebook, and I think that many people have heard about the Facebook IPO even though they were trading, or I'm sorry, even though they are not trading, and certainly if they were trading, because it was pretty big news at the time. So here we have a picture of the New York Stock Exchange where professionals buy and sell millions of shares of stock per day. In fact, billions of dollars are exchanged on the stock market every day. I never went to the New York Stock Exchange, although I want to, but I did go to the Chicago Board of Exchange and was observing the traders on that floor, and I got to tell you, man, that's pretty crazy looking, and I think I'd rather be trading the way that we trade than quote professionals. So if the exchange that the company is trading on is located in America, it's going to be traded in US dollars. If it's traded in Canada, for instance the Toronto Exchange, it's going to be traded in Canadian dollars. Here we have a picture of the loonie. I'm not sure where the name comes from, the bird on the coin, or is it a comment about the people? Francine, if you're listening, no offense intended, or any of our Canadian friends. If we're on the Singapore Exchange, it's going to be traded in Singapore dollars, and so forth, wherever shares are bought and sold. To trade shares of stock, we're going to need a broker. One of the questions that we're always asked, no matter what seminar we go to, is what broker does Courtney or the team recommend? So I'm going to give you the official answer, and I'm going to give you a workaround answer. Would that be okay? Cool. So the official answer is we're not allowed to recommend any specific broker. However, what I can tell you is that if you Google the top 10 brokers, you will find a list of brokers, and on that list are brokers that many of our clients say they have had good experiences with and are very happy with. The first one on the list is Interactive Brokers. And I will tell you that if you're a beginner trader, you may not want to use Interactive Brokers because they have a very advanced platform, difficult to learn, and it's not very user-friendly. But there's other ones on there like Fidelity, Scottrade, Ameritrade. Those are easier to use, more user-friendly, and kind of designed for the retail trader. So it's time for a little trader language class. I had some people write in and ask me to go over this concept tonight, so here it is. We want to discuss long. So what does it mean when traders say long? Well, for example, if I say I'm long Apple or going long Apple, that means I've bought shares of Apple or I'm buying shares of Apple. The reason is because I think the share price will go up. So I would say that I would be going long Apple. So some more terminology would be when I want to go long, I need to enter a buy order for Apple on my broker platform. We're going to talk about orders and the different kinds of orders on a different webinar, but for tonight, let's just say we're going to enter a buy order for Apple on our broker platform. When the entered order that's just sitting there waiting for the price to trade up to it is executed or filled by the broker who's buying the shares for me, it becomes a live, active position. In other words, it starts out as an entered order, and when it's filled, it becomes a live position. Now, if I'm in that position, I profit if the price of Apple goes up, and I lose if the price of Apple goes down. So I have the opportunity to profit or to lose. Short. This is kind of the opposite of going long. If I say I'm short Apple or going to go short Apple, that means I've sold shares of Apple or am selling shares of Apple because I think the share price will go down. And I don't want to get into the mechanics of it, but at any rate, when I go short, I think that the share price will go down. So I enter a sell order for Apple on my broker platform, and when the entered order is executed or filled, because the price is traded down to my sell order, the broker will sell the shares for me, and it becomes a live, active position. If I'm in a live, active position, I profit if the price of Apple goes down, and I lose if the price of Apple goes up. Now, when you buy or own stock or shares of stock, we get to have certain rights and privileges, and theoretically, we would get to vote for the board of directors. And the board of directors select the CEO, and so indirectly, we would be exerting quite a bit of control over the company. However, in real life, most of us are never going to own enough shares to really exert any control and be able to squeeze the management, because you need at least 5%. And 5% of a billion shares is a lot of shares. So most of us in real life don't buy for control of the company. So if not control, then why? Well, we buy stocks for profit. We want to make money. And not only do we want to make money, but as Courtney says, our job is to make massive, serious money. So we buy for profit. And we can profit in two ways. We profit if the price of the stock goes up, and we profit by having the company that sold us the shares pay us a dividend. So a company can pay the shareholders a yearly dividend, and an example would be we own 100 shares of McDonald's and we hold on to it, and it pays 3.1% dividend. So one share of McDonald's costs about $94 plus or minus. So we would multiply $94 a share times 3.1%, and that gives us $2.91 per share. So that means we get, if we have 100 shares multiplied times $2.91, we get $291 per year as a dividend for holding those 100 shares of McDonald's. Courtney has strategies that involve buying stocks for dividends, and if used correctly, they can be an important way to make money. But usually, we buy stocks for capital gain. And that means that we do our analysis, fundamental and technical, and we decide which stock we want to buy and when we want to buy it. As the caption says, just the facts, ma'am. We don't buy on emotion, we buy it on the facts. So this is a picture of us doing our fundamental and technical analysis. So in a bull market, we want to be buyers. So we analyze the stocks, find which ones are in a bull market. For instance, best of best stock. That would be in a strong bull market, and we'd be buyers. In a bear market, we want to be sellers. So we would do analysis for this technique for being short sellers, and we would sell in a bear market. And in a neutral market, we would stand aside and wait for the trade to come to us. So here we have some time for some questions. So I see some people have written some questions in. Is growth stock buying for dividends? And the answer to that is we usually buy growth stocks for capital gains, because growth stocks are usually exhibiting strong growth kind of in the sweet spot, kind of like best of the best. So no, we would probably be buying for capital gain. But thanks for the question. Oh, and regarding the Canadian loonie, it's the bird on the coin. Thank you, Avery. Okay, so good. So that's all I have for you tonight. And I want to thank you again for showing up and listening and having an interest in the Basics with Bruce webinar. And we'll see you next week. Have a good evening. Bye-bye.